Hi, my name is Al Stanley. I'm the CFO of Medford Township. Today, we're going to hear a presentation from Matt Holman and Chris Bentley. Just quick reminder, just one more time, please, silence your cell phones so we can get through the session. First, I'd like to introduce Matt Holman. Matt and Chris are members of Holman, Franey, and Allison. Matt has been a member of the team since 2003. His areas of expertise include audits and non-attest financial services of municipalities, fire districts, school districts, county and municipal libraries, and nonprofit organizations. He has extensive governmental auditing experience and assists local government entities with their municipal budget process. Matt graduated from Franklin and Marshall College with a BA in accounting. Additionally, he has been an integral part of implementation of a firm-wide quality control program since being named Director of Quality Control. Matt specializes in designing and improving internal control systems for governmental entities to help safeguard against fraud and help entities achieve business objectives. Our second presenter is Mr. Chris Bentley. Bentley has been a member of HFA since 2011. His areas of expertise include audits of municipalities, fire districts, school districts, counties, and municipal libraries. Chris graduated from Moravian College in Bethlehem, Pennsylvania, with a Bachelor's of Arts degree in accounting. Additionally, Chris has been an integral part of implementation of a firm-wide quality control program as well. Chris has been a leader firm-wide in internal quality control, development, and adherence. And without any further ado, it's Matt and Chris. Thank you.
Thank you, Al. Good morning, everyone. Again, my name is Chris Bentley. I'm an audit manager at Holman, Franey, Allison. This is Matt Holman. Matt's an audit manager at Holman, Franey as well. We both work in our firm's governmental services department. Currently, we have between, Matt, 50 to 60 municipal clients in a couple counties. So we're very knowledgeable and we have a lot of experience in this particular area. I would say welcome to the GFOA conference in Atlantic City, but it seems like a lot of you have your bags packed and you're ready to get out of here soon, about an hour or so. I'm sure everybody's ate too much, drank too much, lost all their money by now, so everybody's ready. But I hope you enjoyed the conference so far. Seemed like there's a lot of good speakers, a lot of good topics, but we do have one more topic for you, so hang in there. We'll try and get through this as quickly as possible so you guys can get on your way. I do ask that you hold questions to the very end so we can kind of get through this quickly. So a canary in the coal mine, what my general ledger is telling me. When Matt first asked me to do this topic with him, I honestly had no idea what that meant. I said, Matt, I don't know anything about coal mines. All right, so I know what we're doing. It's a good thing for Google. And for those of you who don't know, a canary in a coal mine is tradition dating back to the early 1900s, when miners used to carry down canaries in the mine tunnels with them, and if dangerous gases such as carbon monoxide fill the tunnels, it would kill the canaries first, thus warning the miners to exit the tunnels. There's been some technological advances since then, and I'm sure the animal control groups were not too happy with that, so that stopped about 30 years ago, that tradition. So this presentation is going to be your canary. Matt and I, over the next 40 minutes or so, will go over the warning signs that there might be carbon monoxide gases killing your general ledger. Matt tried to put our heads on these things too, but it was pretty creepy.
Next one.
Next one.
Yeah. It came out pretty bad. I'm definitely better at accounting than I am at graphic design.
Yeah, it was a little creepy, so we just put our names on there. So a general ledger review. What is a general ledger review? A general ledger review is the process of analyzing and performing certain analytical procedures to your general ledger balances and transactions to provide reasonable assurance that they are accurate and free of misstatement. In addition, the reviewer verifies that transactions are appropriate and that they are compliant with the New Jersey's specialized basis of accounting, which is a regulatory basis of accounting. And now Matt's going to kind of go over why it's important to have a general ledger review.
All right. Thank you very much, Chris. So really, why is it important to review your general ledger? It seems pretty obvious, but we're going to go through some things that hopefully will open your eyes to why this is really a crucial step. When it's performed accurately and timely, this really should prevent or at least minimize any audit findings that your independent auditor might come in and have for you. Not just your independent auditor, maybe your state auditor, federal auditor doing a particular grant audit, something of that nature. But really our goal here is to really minimize any of those audit findings, or at least help you prevent any of them that we may be able to. Also, if your internal control policy has this as a feature, which I think really all internal control policies should have it as, then this should really be a mandatory step in your internal control procedures. Go back one there. Yeah, okay. So internal control, that brings me to my two favorite words. I absolutely love internal control. It's a sickness that I have. I can never really speak enough about the importance of internal control and really the documentation of your policy and procedures. So we'll start here. And when we talk about internal control and we talk about this general ledger review, what we're really talking about is the management oversight function that's built into your internal control policy and procedures. And just to quickly define, when we're talking about internal control, we're talking about the process for achieving your organization's objectives. Just really simplified there for you. And really one of those main objectives that every organization should have is to provide the most reliable financial reporting possible. And really the cornerstone of that reliable financial reporting is the strong internal control policy and procedures that lay out the managers' oversight duties. So, in your internal control policy and procedures, you really should have a section entirely laid out for management oversight objectives. And this is going to fall directly into that spot. And the internal control structure should be designed to include this oversight of your general ledger. And it should be performed within a timely manner. So we kind of get the question then at that point a lot of, well, what exactly do we consider a timely manner to be when we're talking about a general ledger review? And we have a rule of thumb that I use a lot, and I'll tell my clients, we'll say monthly, but really, the answer isn't always that easy. There's a lot of different factors that can go into giving the proper answer to that question. And it's really because each general ledger, it's made up of different accounts, and each account is going to have different characteristics. So, while we say monthly is a good rule of thumb for you guys to have when you're doing this review, you could have to consider it reviewing it not only as a whole, but maybe in particular accounts within your general ledger may need attention more than on a monthly basis, or more frequently than a monthly basis. Or some accounts, you may be able to leave to a yearly basis, something to that nature. All right, so what we wanted to kind of give you, though, is a couple review frequency determination factors. So we're just giving you 4 of these key factors to consider when you're talking about how timely you'd want to perform this review. The first one, volume. Really the number of transactions or occurrences of a particular item in your ledger, maybe the amount of volume that's running through a particular account transaction-wise, the physical number of transactions, important to consider. Materiality. Really, should you even be looking at this account? Is it of a significant enough value to you that it even warrants your attention? So that's important to consider. Business purpose is another one. What is the actual importance of this transaction to your entity? And then my favorite, riskiness. And this goes hand in hand with your internal controls here. I like to break the riskiness aspect into kind of two different types. You have a riskiness that's inherent to any kind of transaction. And what I mean by that is, the type of transaction will warrant a certain riskiness in itself. So like cash, for example. Cash is very easily misappropriated. So therefore, it's going to be way riskier than some of your other basic accounts that you have. And the other type of risk that we have is kind of a control risk that you have within your general ledger here. And it could be because you have staff that are of different quality or experience that may be inputting numbers into your general ledger or performing certain journal entries, whatever it may be. So that's a separate risk all in itself that you would have to consider. All right, so let's just dive a little bit deeper into that final factor there. I do think that's probably the most important, and what you're dealing with there is the riskiness of the accounts. So this is really an important aspect of your internal control structure that in many places that we go into is still overlooked. And what I'm talking about here is really the internal risk assessment that should be performed when you're documenting your controls and procedures. And what do I mean by this risk assessment? It's really the identification and analysis of relevant risks to the achievement of an entity's objectives. And it's for the purpose of determining how those risks should be managed. So it's a principle that we use every day as an independent auditor when we come in to do your independent audit. We're directing our attention towards your riskiest areas, but it's also a principle that should be built into your internal control structure. You really want to spend your limited amount of time on the most risky areas that you have in your organization. So really what I'm saying is you're given a limited resource and you're determining, and that limited resource in most cases is time. It could be money, but you're really determining what's the best use of my limited resource. How do you best allocate those limited resources that you have? And when you perform this risk assessment accurately and thoroughly, the riskiest areas in your particular municipality will be identified and your management oversight can be directed towards those areas first. So this will also limit your chances of not detecting an error or fraud. I mean, that's the ultimate goal here, is we really want to get to the areas where there's problems. And if we had all the resources in the world, we could look at every transaction that happens internally and externally. And as auditors, it's a principle that everybody uses. And, there's no reason why it shouldn't be built into your internal documentation as well. All right. So, the practice of assessing this internal risk can be rather difficult when you don't have extremely well documented policies and procedures. And I'll go back to this a lot. It's my favorite topic. Everybody should have very well documented policies and procedures in place. It amazes me still just how many places that we'll walk into. And, we're doing our normal audit, and as part of our step, we'll look for policies and procedures, and in some cases, we'll not find any. In a lot of cases, we'll have very boilerplate templates that are not designed specifically to the entity we're even looking at. It's kind of shocking because it really should be the cornerstone of good management that's going on in these different municipalities. So, if you feel that you can use some improvement in that area, or you may need some more convincing that you need some improvement in that area, let me give you some of the advantages to formal policies and procedures being put in place. And you'll see here, we listed them out on the screen here for you. I won't go through all of them. But really, you're promoting good financial management practices, and these practices usually will outlive their creators. I mean, once this is put in place and it's really done thoroughly and well, it's not something you're going to have to revisit all the time. This is going to be here for a long time. And it's going to promote stability and continuity throughout your municipality. Also, it's going to prevent the need to constantly reinvent responses to the same reoccurring issues. So the next people who come in after you are obviously going to run into similar problems, but when your internal control structure is designed very well, most of those answers are already given to you. It's going to create a clear strategic intent for financial management. It really is kind of the layout or the design for the organization and how the organization plans to manage the resources that it has available. And it lays it out all on paper, so there's no confusion. It's going to define your employee boundaries. It's going to tell them what they can and can't do. And they should be very aware of that in all of their different roles, what they should be doing and what they should not be doing. And of course, it's going to support good bond ratings, which will therefore reduce your cost of borrowing. You know, bond rating agencies are going to absolutely love the detailed documentation that you're going to show them with your internal controls. But most importantly, you know, they're going to help you manage the risks to your financial condition. And one of the things that we're talking about directly here, the management oversight aspect. That needs to be built into this, and it's going to help you manage those risks that we're talking about. Okay, so that's all I have for you on internal control, I swear. That's it for today. We'll get back to a little bit more of the detailed steps that we look at. But let's go back real quick to the question and kind of summarize the best answer that we can have for that. And again, that question was really, why is it important to review your general ledger? So ultimately, we're looking for accurate and timely information to be given to your decision makers. That's ultimately what we're doing here. And financial decisions, they need to be made constantly, accurately, and timely. So if we're not providing a general ledger that has that accurate data in it, you know, there's going to be poor decision making happening within your municipality. You know, you can't make these good decisions without having the best data possible. All right, I'll give it back to Chris at this point. Less internal controls, I promise.
All right, so now that we know what a general ledger review is, and we know why it's important, now I'm going to talk about how do we complete a general ledger review properly. I've kind of narrowed this down into two components. Component number one, reviewing your accounting for accounting errors and potential problems. I further narrowed this down into 3 basic steps using analytical procedures. Step number 1, reviewing for the obvious problems. Step number 2, tracing to supporting documentation. And number 3, performing certain calculations that are unique to the New Jersey regulatory basis of accounting. And then component number 2, which we'll talk about a little toward the end, is benchmarking your general ledger. I think Matt's going to talk about the obvious, you know, when you first run your general ledger. Matt's going to discuss the obvious problems once you print your general ledger.
Yeah, so when we first walk into a place, a lot of times what will happen is we'll look at this general ledger, and it surprises me how many places we go into, and we still see really obvious mistakes in general ledgers. So you can tell, as I was talking about before, that really this isn't happening. There's not a step that's been built in where the review of this general ledger is happening in a timely manner. And what do I mean by that? So some basic issues that we still see, believe it or not, you know, your debits and credits don't balance. You know, that's a pretty obvious one. I hope that that's not a overwhelming problem. But there's still places where we'll go in, and believe it or not, there's been some kind of one-sided journal entry done, and you end up with debits and credits that don't balance in your general ledger. So that's a very easy one to kind of knock out right out the door. Along those lines, asset accounts carrying a credit balance. Sometimes we'll walk in and we'll see that there'll be a receivable set up, but it'll have a credit balance instead of a debit balance. These are easy targets for us. I mean, obviously something went wrong. Most cases, either the receivable wasn't initially set up and then somebody booked a receipt to that receivable, so it ends up showing as a credit balance, and there needs to be some kind of adjustment made. Same thing can be said on the liability side. We see our fair share of account payable balances that are actually a debit balance instead of a credit balance, and same kind of thing. Those are pretty obvious though, and I hope that, that simple review of the general ledger can eliminate most of those problems. Chris is going to get into some of the more detailed things that we see.
All right, now that we've fixed the obvious problems, the next step is going to be to trace your general ledger to the supporting documentation. And I would start with cash, and you're going to end with your fund balance. And these are a lot of steps here that we actually do as auditors when tracing to supporting documentation. You can see here there's a list of examples here that I'll go through, and I'll show you kind of real life examples of what we're talking about. Example number 1, tracing your cash in your general ledger to your bank rec.
You hid the names on these, right?
Yeah, I hit all the names, don't worry. But you can see here, I mean, this should be done on a monthly basis. As you can see in my example here, our cash in our general ledger, which is up top here, does not agree to our bank rec at the bottom here. If they do not agree, I'm not really sure what we're reconciling to. And plugging an adjustment on your bank rec and hoping it works out in the end is never a good solution. I believe in this case, we had 2 separate general ledgers we were keeping, and we were tying the bank rec into an Excel general ledger, so we're keeping both and then doing a large lump sum post-entry to our accounting system. If you are keeping a general ledger just in Excel, your Canary is probably already dead or he's dying. I think Matt can kind of talk.
Just a word on Excel real quick. That's like our least favorite thing, next to not having internal controls, I guess. But you know, Excel's no more than really just pen and paper for us. I mean, it doesn't do the job really anywhere. I mean, we would first and foremost recommend that everybody gets all financial records into some sort of accounting system. Excel has many different issues when you try to actually use it as some kind of ledger. Footing problems, you know, just manual input errors. It's the same as really using pencil and paper in many respects, and almost sometimes more dangerous. So just keep that in mind. You know, if you can get your records into some kind of accounting software, it's always going to be advantageous.
Example number 2, tracing your debt, your serial bonds payable, your bands, to your amortization schedules. You can see here on the first slide we have our general ledger balance of around $7 million in bonds payable, some notes payable of $2.6 million. But when I go to the amortization schedule, sorry, it's small, but at the very bottom here, you can see that serial bonds payable of $9.9 million. So what happened here? It looks like in this case, we issued bonds to pay off the bands, but we never did that extra step and that adjusting journal entry to fix that. Example number 3. Do my taxes receivable, do my liens receivable, do my utility receivable agree to my collector's reports? You need to talk to your collectors. They don't smell, believe it or not. Most of them are very nice. Have them run reports at the end of each month and sit down with them and reconcile any differences that you guys have. You can see in this example here, my general ledger is up top. I have $403,000 in taxes receivable. I have $82,000 in my tax overpayments. I go to my collector's reports, and we're in agreement at the bottom here. Beautiful. I guess this CFO and this tax collector actually like each other, so that's good. Example number 4, tracing our revenues and our expenditures or our appropriations and our anticipated or unanticipated revenues to our subsidiary ledgers. You can see in the example here, the GL chart of accounts is up top, and my revenue subsidiary ledgers at the bottom. And I'll use unanticipated revenues as just an example. You can see up top we have $602,000 in unanticipated revenues, but when I come down to my subsidiary ledger, I have $976,000 in unanticipated revenues. A common mistake that we see is misproper classification between unanticipated and anticipated. A lot of times we'll have an unanticipated, that's a anticipated revenue this year, but not the following year. And we never kind of do that next step in the system to make sure our general ledger accounts are linked properly to our subsidiary ledgers. Here's another example up top here. I have my detailed budget account status report up top. You can see on the very far right, my unexpended balance of almost $40 million. And then when I go to my GL chart of accounts, does that equal my liability, my appropriation reserves accounts? And we're in agreement here, so very good. The last example of tracing to supporting documentation is tracing your grant receivables to your grant awards. And this should be done on a monthly, on a quarterly, on a yearly basis to still see if those grant receivables are still valid. We've had a lot of instances where, as auditors, we're confirming with our grantors the receivable balance, and there's been differences. And when we have to cancel those receivables, it gets canceled to fund balance, probably because of some misposting of a receipt. There's, as part of your handouts in there, I put a few pages of some common adjusting journal entries for you guys to look at that I think will be helpful to you guys. I'm not going to go over all those adjusting journal entries, but some common adjusting journal entries that we see as auditors are not charging your budget correctly, not charging your deferred charges out or your grants out, the tax or utility levy not being properly entered into the system, or not accounting for cancellations or overpayments or any of those other non-cash activity that happens in your tax reports. Again, we should be talking to our tax collector to really reconcile these differences. Once we've gone through our tracing our general ledger accounts to our supporting documentation, the next step is going to be to perform some kind of unique calculations for New Jersey basis of accounting. And I provide some examples here. This is not all inclusive. The first calculation is going to be tracing your grant receivables or comparing your grant receivables to your grant appropriations. And you can kind of see this analysis of what I've done up here, and this should be done on a monthly basis or at the end of the year. And what we're doing here, we're comparing the grant receivable to the grant appropriation, and we're calculating the difference. If you have a negative difference, that means you have spent the money that we do not have. If it is not a reimbursable grant, then this could be a problem here. There could be a misposting. And we do this analysis as auditors because this is almost, as Matt was saying before, this is almost a risk assessment for us of if there's a negative balance, then guess what? We're probably going to hone in on those grants where there's a negative balance and it's not a reimbursable grant to do our grant testing of receipts and disbursements.
This is also, just to expand on that, with the basis of accounting that we have in New Jersey here, nearly cash basis, and this is one of the few areas where you'll see that, receivables are being booked, and if you don't receive the money in, you could really get yourself in trouble. So again, for us, as Chris was saying, when we perform our risk assessment as auditors, this checks the box as being a risky area because it may end up in having to cancel a receivable, which in turn will have to be made up by the current fund balance.
All right, calculation number 2, an interfund analysis. Now, even though this is not unique to just New Jersey basis of accounting, this is kind of a calculation that should be done for all governmental funds. What I've done here is take all of our general ledger interfund accounts, combine them into a little analysis, and do our interfunds payables equal our interfund receivables. And also I want to point out that this not only applies to interfund payables and receivables, this should also be done for interfund reconciling items. a common mistake that we see as auditors is there'll be a interfund reconciling amount into one fund as an outstanding check, but there's not a DIT on the other side of the fund. So this same kind of analysis can be done for that. Another calculation is comparing our receivables to our reserve for receivables. So you can see at the top here, I have my asset receivable accounts. At the bottom here, I have my reserve, my liability for accounts. And you can see here that my taxes, my delinquent taxes equal each other, my tax title liens equal each other, all good. But when I come down to my interfund receivables, it looks like we're having some problems here comparing to the reserve for receivables. So again, this could be another adjusting journal entry, and this could affect our fund balance. The last calculation that I have is in terms of deferred charges in your general capital fund. Do my deferred charges funded in my capital fund equal my serial bonds payable, my loans payable, and any other permanent financing sources? And then do my deferred charges unfunded equal my bond anticipation notes payable, plus my bonds and notes authorized but not issued, plus any other temporary financing sources. So when I think of these as kind of as their own balance sheet, so you can see a sample here. I have deferred charges funded of $12.5 million, and they equal my serial bonds payable plus my green trust loans payable. Here's an example of a deferred charges unfunded as its own separate balance sheet. You can see my deferred charges unfunded here. I have a $702,000, and that equals my bond anticipation notes payable plus my bonds and notes authorized but not issued. A very simple calculation we can do to see if there's any kind of errors in there. Those are all the examples I have in terms of tracing to supporting documentations and calculations. We have a lot of other calculations and supporting documentation we could show you, but because of time restraints, we kind of just wanted to give you some common examples. So Matt's going to talk about the kind of that second component of our general ledger view, which is kind of benchmarking your general ledger now.
Now that we've reviewed our general ledger, I just wanted to talk briefly about benchmarking. I know I don't want to hold anybody's lunch up here either, but if you guys want to get into any more of these, feel free to come see us afterwards and we can talk about the different benchmarks. But I'll jump directly to the most popular one, the one that I see quite often. Not even maybe from CFOs, but more from elected officials. When we sit in finance committee meetings or exit conferences for audits, the most popular one that we see is really fund balance. Where should my fund balance be? How do I know what is an appropriate number for my fund balance to be? And, what I've kind of leaned towards telling people is that, there's really no perfect answer to that. I mean, each place is going to have its own characteristics, and there's different characteristics that are going to have the need for a greater amount to be put into the fund balance. But I will say we do use a certain few rule of thumbs that we can share with you. The first one, let's see here. See, there's a lot of information on these slides. Feel free to read through, but I'm not going to hit everything there. And this is one that the GFOA supports. It's actually on their website. If you dive into the best practices, you'll find in there, they will tell you that you really should maintain no less than 2 months of your regular current fund operating revenues or your regular current fund expenditures. Now, you choose revenues or expenditures, you'd want to choose the one that's less volatile, the one that's going to have the less amount of one-time things happening. But that's going to be their general rule of thumb for what your minimum fund balance requirement might be. It's always a good idea also, getting back to internal control real quick, you really should have a documented policy and procedure on your fund balance plan. That's something that I see very infrequently, and it's a good idea to really document out what you plan to do with your fund balance. It shouldn't be a surprise to anybody, and it really should drive a lot of the different objectives that you're going to have in your internal control documentation. Plus, your governing body should really know that plan and should have access to it as well. So a second benchmark, that I'll bring up about that fund balance, and one that bond rating agencies I've seen use frequently. You'll see on this slide right here. Let's see, it's pretty clear actually up there. If you look at that first line, you'll see your fund balance as a percentage of your revenue. So this comes from a bond rating agency, and this is really telling you kind of from their perspective what they see to be a strong point or a weak point in your fund balance here. So you can see very strong being over 30%. I mean, I think we might all agree that's a pretty large number there. But when you get into that strong range, the 30 to 15% range that's generally where we'll end up telling our clients that it's a good place to be. Obviously, once you start to dip below that 15%, and definitely once you hit the 5%, you're definitely probably have too low of a fund balance there when you're at that 5% mark. And especially because, if the bond rating agencies do deduct from your rating because of this, then obviously it's going to cost you more in the long run to not be carrying that fund balance. So, what is the right amount for you, though? Just some things to consider, and why I say that there's not an easy prediction for anybody to just walk in and say, okay, this is where you guys should be at. Disasters. I mean, we've had enough of our clients that have gone through this lately. Sometimes when you get into emergency situations, you're going to need a higher fund balance number. So how susceptible are you to that? Immediate capital needs. You may need something for capital that comes up. Same thing, any emergency situation that you get into. And of course, if you're subject to state aid cuts, budget cuts, you're going to need a larger number there. So that's just a brief overview on the benchmarking. Like I said, I want to make sure we get to some questions if you guys have any questions. And more importantly, you guys can get on their way. Anything else? No? Okay. Any questions from anybody? There's a microphone up here if anybody wants. Yeah, there's handouts on the table in the other room if anybody wants as well, if you didn't grab a folder. And then if anybody would like, please just, if you want to get in contact with us, we can send you the slides so that you have the information.